History sometimes likes to recall particular dates associated with particular memories. The dates or years unquestionably have something to represent, whether it be good, horrible, or disastrous. And for history, there was a year that many people still remember with scars in their heart, the year 1929. What about this year is so disastrous? And why did the year 1929 suddenly become relevant today? Why does legendary investor Warren Buffett anticipate a worse time than 1929? Let's dig deeper, so don't miss any part of today's video. Remember or heard about the Great Depression? From the 1929 stock market crash until 1939, the Great Depression was the worst economic crisis to ever affect the industrialized world. The United States economy grew quickly throughout the 1920s, and from 1920 and 1929, a period known as the Roaring Twenties, the country's overall wealth more than doubled. Economic institutions, macroeconomic policy, and economic theory underwent dramatic adjustments as a result of the industrialized West's first downturn of this duration and intensity. Although it began in the United States, the Great Depression had a significant effect on almost every country in the globe, causing large declines in output, high rates of unemployment, and severe deflation. Everyone from billionaire businessmen to cooks and janitors invested their funds in stocks on the stock market, which was concentrated at the New York Stock Exchange on Wall Street in New York City. As a result, the stock market expanded quickly and peaked in August 1929. During the summer of 1929, the American economy experienced a slight recession as consumer spending decreased and inventories of unsold goods increased, which in turn affected industry output. Even so, stock prices kept rising and by the fall of that year had reached extremely high levels that were incomprehensible in light of projected future earnings. The Great Depression, which lasted from 1929 to 1939, was the worst economic depression in the history of the industrialized world. The 1929 stock market crash, which paralyzed Wall Street and resulted in the loss of millions of investors, was the catalyst for its beginning. The following years saw a decline in consumer spending and investment, which was followed by a rapid decline in industrial output and employment as failing companies lay off people. The timing and intensity of the Great Depression varied significantly by location. The Depression was noticeably extended and severe in the United States and Europe, as opposed to Japan and other regions of Latin America, where it was milder. It may not come as a surprise that several variables played a part in the world's worst economic downturn ever. The United States' economic output declined as a result of declining consumer demand, financial panics, and bad government policies. The gold standard, which linked almost all countries in the world to a network of fixed currency exchange rates, played a critical role in spreading the American downturn to other countries. When it peaked in 1933, there were 15 million unemployed Americans and nearly half the nation's banks had failed. But just before that time, the situation was so contrary. During the first part of the 1920s, businesses had great success exporting to Europe, which was recovering from World War I. Unemployment was low, and the proliferation of automobiles across the nation helped to boost employment and economic efficiency. Before reaching their peak in 1929, stock prices soared by roughly 10 times. In the 1920s, individuals who could afford it, as well as those who could not do it often because they could fund their investments by borrowing money from stockbrokers. Stock prices were then far greater than their true value because production had already decreased and unemployment had increased. Additionally, the agricultural sector of the economy was struggling owing to the drought and declining food prices, salaries were low, consumer debt was out of control, and banks had an excess of huge loans that they were unable to unload. Society experienced a tremendous economic rebound thanks to a percentage of GDP that had never been attained before and never averaged since. But people's brains were so wounded by 1929 that memories of it were passed down to future generations. The primary cause of the Great Depression, according to economic historians, was the sudden, catastrophic collapse in U.S. stock market values that started on October 24, 1929. Nevertheless, some contest this finding, viewing the stock market crash less as the cause of the depression and more as a sign of investors' growing trepidation as a result of gradual price declines brought on by declining consumer goods sales due to overproduction brought on by new production techniques, declining exports, and income inequality, among other factors, which had already started as part of a gradual depression. The U.S. stock market plummeted by close to 50% during the crisis, while corporate profits plunged by more than 90%. The American economy increased rapidly over the remainder of the decade. The American public first learned about the stock market during the Roaring Twenties and jumped in with both feet. Before October 1929, equities prices reached historically high multiples of almost 19 times after-tax corporate earnings. On October 24, 1929, often known as Black Thursday, the NYSE bubble broke abruptly. Both on Friday, April 25, during a half-day session, and on Saturday, April 26, there was a small rally. And then came on Black Monday, October 28, and Black Tuesday, October 29. In those 2 days, the DJIA decreased by more than 20%. Eventually, the stock market would decline by roughly 90% from its 1929 peak. Other financial catastrophes, such as the failure of the Bodencredit Anstalt, the most significant bank in Austria, were caused by the crash's aftershocks that traveled across the Atlantic Ocean to Europe. The financial crisis struck both continents hard in 1931. The U.S. economy collapsed as a result of the 1929 stock market crash, which destroyed nominal wealth in both the corporate and private sectors. Early in 1929, the unemployment rate in the U.S. was 3.2%. It increased by over 25% by 1933. The unemployment rate remained at 18.9% in 1938 despite historic government spending and interventions by the Hoover and Roosevelt administrations. When the Japanese destroyed Pearl Harbor in late 1941, real per capita GDP had fallen below 1929 levels. A significant market for American farmers' products was lost as a result of the Great War's aftermath and the rise in output in Europe. As a result, the United States passed several laws. Congress raised import duties from Europe. But the levies went beyond agricultural products, and several governments also imposed duties on imports from the U.S. and other nations. For international trade, the overproduction, oversupply, and higher prices brought on by tariffs were disastrous. There was a 66% decline in world trade from 1929 to 1934. The wealth disparity reached its most extreme points in the 20th century in 1928 and 1929, when half of the unemployed had been out of work for more than 6 months, a situation that was not duplicated until the late 2000s recession. The world finally reached levels of wealth gap inequality that were comparable to those of 1928 and 1929 in 2007 and 2008. Several Latin American nations experienced an economic downturn in late 1928 and early 1929, a little bit before the output decrease in the United States. While some less developed nations went through catastrophic depressions, others, like Argentina and Brazil, only went through relatively minor recessions. And now, Buffett cautioned us against having unrealistic long-term expectations. He cited this history in his speech. Charlie Munger, Buffett's business partner at Berkshire Hathaway, warned of a perilous market bubble almost 2 years ago, claiming that investors were dangerously close to playing with fire. According to several economic indexes, Buffett is the richest investor in the world, with their fortune estimated to be worth $104 billion. His holding firm, Berkshire Hathaway, has investments in a variety of companies including Apple, a technology company, railway interests, battery manufacturer Duracell, and the fast food franchise Dairy Queen. And now experts are concerned about inflation. At the gas station, the grocery store, the post office, and even the barbershop, we can sense it. I'm sure you too are suffering from this. Since the rate of economic growth is less than the rate of inflation, the real gross domestic product for the first quarter of 2022 fell by 1.4% from the previous year. The U.S. economy will formally be in a recession if the second quarter's readings remain negative. Both Buffett and Munger discussed the status of the economy in terms of inflation and how it is mostly the product of lax fiscal and monetary policy. This approach effectively created a supply-demand imbalance, which was treated by raising prices to reduce demand. Saying that inflation is inevitable is fine and desirable. However, the true concern for most investors is undoubtedly how to prepare their portfolios for long-term inflation. The first thing to keep in mind is that economic cycles are merely a part of a long investing career. It matters less whether or not inflation is to blame for a sell-off. The greater point is that investors in businesses with promising futures, healthy cash flows, and solid balance sheets can achieve wealth that will change their lives. That's the pro way to do this, and you can easily survive the blow of recession. Don't you think so? If you do, express your thoughts on this in the comments below. We would love to know your opinion on this issue. Well, this brings us to the end of today's video. We hope you liked the video. If you did, make sure to hit the like button, and for more such informative videos, subscribe to the channel, and don't forget to press the bell icon to never miss an update from us. We'll catch you guys in the next one. Until then, peace.